morning, all of our investor webinar attendees. Can everybody hear me okay? Little echoey? No? All right. Well, we're excited to have you with us. And Chris, if you don't mind just continuing to admit people as they jump into the lobby, that'd be great. Thanks for joining us this morning. If you're in the Central or Eastern time zone this afternoon, we're excited to have you with us. We're going to dive right in because we have a special guest with us today, Jonathan Beukelman. Jonathan is a world famous and nationally recognized wealth advisor and has been a friend to me for, I don't know, 30 years. And also a source of wisdom and insight for me over those many years on all things financial, sometimes on parenting. So that's also where I go for advice. So we're excited to have Jonathan with us today, and we're going to just kind of dive into, this big question about what we just had a big election, a lot going on in our country right now, certainly consuming the news cycle. And for those of you who invest in and own real estate, it's a great time to ask the question, what does this mean for the real estate market going forward? What does it mean for investing going forward? What do we kind of anticipate right now? And how should we be making decisions in light of that? So we asked Jonathan to join us, and I think we have a few slides that we'll go through. Chris, if you want to just start presenting, I think that would be appropriate, and we can dive into this. So Jonathan, thanks so much for joining us. If you go to that next slide, we get to see that Jonathan Beukelman is the Managing Director and Generational Wealth Expert at UBS. And he sits here in Denver and serves clients all across the United States and internationally. So Jonathan, I guess before we dive into your slides, my big question for you really starts out with, what do you make of this election, and kind of how are you thinking about the market, real estate, and the market broadly post-election?
Yeah, thank you. And Tony, I think we've been friends for 35 years. I think there's been at least 4 or 5 times where you've tried to unown me as a friend. But I kept you on, which is good because it's really hard to have 35-year friends. I mean, it takes a long time to have those. So anyway,
it's a rare thing. It's a rare gift.
Yeah. So thanks for having me on. I think one of the things that, when you hear people talk, you kind of I wish everything would say, what are your natural biases, right? And so as I talk, I would say that especially about the election, just know that I'm a conservative who doesn't really love the idea of Trump. And so I think I'm saying that not for you to judge me right off the bat, but just to kind of know a little bit about a bias that we all kind of talk through. And I just thought I might want to get that out there. As far as real estate's concerned, I'll get into that a little bit. But as I think about the markets, my number one idea that I like is a split House and Senate. So I think I told Tony this. I said, Tony, ultimately for me, longer term, the top spot matters. Those second couple areas matter to me even more. And so what I've noticed with my clients, at least, is that the idea of risk since the election's gone up. So my Democrat clients that I have, my independent clients that I have, my conservative clients that I have all wanted to become, since the election, more risky, which I find fascinating. And so one thing that I look at with history, whether it be Ronald Reagan, the markets were unbelievable there, Bill Clinton, Barack Obama, there were a lot of times were different. The Republicans and Democrats won the main office, but the markets did the best when things were gummed up a little bit, when people couldn't get all the things done that they wanted to get done. So as I think about, the Trump administration, I think that the upside with investment in this country is very high, but I think that the outcomes are very wide, meaning that I think that it could be a disaster too, with being able to get everything done at the same time. So I think there's a wide range, and I don't know really how it's going to go. And so as I think about this election, people are calling me saying, hey, do I take more risk? And I'm saying probably not, because we don't know what these outcomes will be. I think that as I go to real estate for me is kind of a measurement of interest rates. So where will interest rates go? So the popular belief on every podcast that I've ever listened to is all of a sudden everybody's really concerned about the national deficit. So in my career of 24 years, about every 4 to 5 years, usually on an election cycle, the pundits are like espousing the concern of national deficits. And if you look at our world, what I think we're dealing with is a huge national deficit. But if you look at China, you look at everybody else, we're probably the least dirty shirt out there. And so, the biggest concerns I remember is going, in 2013, 14, when the deficit was half the size it is today, people were very concerned. And so what I think in markets today are priced a little bit for perfection, like the stock market, for example. But I think with real estate, I think it's so industry specific. I think it's so state specific. And so if I look at housing, the need is there. If I look at industrials, I laugh because if you look at our industrial portfolios, they pay the same, if not more income than they did a few years ago. But if we sold them, they'd price down. And I think it's because they've marked up so far 2-3 years ago. Everybody's freaking out about commercial and how bad it is and all that. And the smartest investors that I know that are big are taking things out, for example, in the tech center at 25 cents on the dollar. And just making the bet. I'm like, are you converting these? They're like, no, I'm just making the bet of back to work. And I'm like, oh my gosh, that sounds crazy. Like, have you not watched the news lately? Like, what are you guys thinking? But they're like, yeah, I think the back to work thing is going to happen. We've seen it. And what I've seen is also in our job, when we post a job for our business, we used to have applications of, 3 or 4 people wanting a job. And now the numbers are in the hundreds. So what I think things are converting to is there's some equilibrium between employer and employee a little bit there. And so that's interesting to me that they're doing it. Am I doing it? No. Other people, you get rich by concentration and you stay rich by diversification. And by the time people get to me, they tend to be fairly wealthy. And it's kind of my job to pass it on to the next gen. So one thing that's not very popular is actually, could you bring up my first slide if you don't mind? One thing that's very popular is this concern that we're going to have really bad inflation that's going to go higher, and that's why rates need to be higher. If you look at this chart, we're going back and we're basically down even at these levels, not where the Fed wants to be, but below the average, the historical 50-year average of 3.7% on headline CPI. Food obviously is a little bit nasty. Airline flights are really expensive. Energy's down. But the direction of inflation is pretty attractive right now. Go to my next slide. If you look at where the market is on where interest rates are going, if you listen to every podcast, everybody's talking about rates are going higher. So let's say that we're at, I don't know where we are today on the 5-year. Are we, Tony, do you know where we are on the 5-year treasury today?
A little over 4.
Yeah, I think it's like 4.3. Hold on.
The 5-year
is about 5. Yeah, about 4.3.
Yeah, 10 years at 4.
Yeah, so if I look at like what Brown Brothers and Harriman puts out and all that, they see 3s for the 5-year. And I know that a lot of our real estate clients, when they do a development project, they tie their loan to like the 5-year, where the bank has like a 5-year treasury, and then they put 3% on top of it or whatever it is. And I think that if inflation is going back up, obviously that would push that rate up. Right here, it kind of shows that the Fed believes that we'll be at 440 at the end of the year this year, and then 340 and 2.9, which is probably not going to happen. And then the market is the green, which is at 379, for next year, on the short rate. I think that the bond market is priced into perfection. Like, we're going to have ultimate growth in the economy. There's no risk. There's nothing out there. We have inflation. We have a national debt that's huge. And so, like, if you listen to these podcasts, they're all like, how can anybody buy a 5-year treasury at 4.3? But you also got to realize the guys that are interesting on podcasts also would never buy a treasury at 8% either. Right? So in reality, one of the things that I look at is, I think that the market is pricing in a very much higher rates than I think what we're going to see. I think the Fed will drop rates. Yeah, they might do it slower. They might, but they are in a cutting cycle, because if you look at what people are spending on their credit card debt, if you look at what people are spending on borrowing for cars, all these things, it is very adverse. Now, if we have a major inflation bubble, that's an issue. But, what's Trump going to do? Like, is he really going to be able, I look at the Elon Musk idea, where we have Elon Musk coming in and cutting, but there's nothing that Trump's ever done that has cut anything. What he does is he grows out of his debt and just gets more. Right. So there's a little bit of this thing where, oh yeah, we want to bring down debt. We want to grow the economy. We want to cut every tax, and we're going to pay for it by tariffs. So there's some things that are taking place that I look at this and I go, yeah, it's awesome. Let's tariff so we can bring more back to the United States. But what does that cost to us? I think it's going to be hard. I think we might throw a couple tariffs on things and it's not worked so well. Maybe we have to take that off. But from a rate perspective, I can see us not having such a perfect environment like everybody's feeling now. I mean, if you look at the volumes that I'm seeing, so I look at my clients that are my lead indicators. So remember at the bottom in COVID, the Dow went to like 17,000. I mean, it was bad. And I had a few clients call me on those days and say, I got to get out of this thing. I'm going to lose all my money. Right. Well, those same people today are calling me and being like, Jonathan, I just got to take on way more risk. And so they're kind of our client lead indicator. Most people look at stats. I just have like four people that are like always way into it and track it really closely and are just always just tipping the top, or they're hurting the bottom. So let's go to the next slide. National debt right now is 97% of GDP. Bottom right slide, we haven't seen that since the 40s. Big deal. Yeah, but with that, we probably don't need too higher rates because the government's going to have to pay that. Be awesome if we could cut $2 trillion out of the economy. But I don't know if there's going to be adverse consequences if we do that. So what can really get done? Next slide. Here's the thing on S&P stock market. So you guys look at your business and you say, you look at the investment world and people that are real estate people. I love real estate people. I was at a conference, it's like a conference for like an adoption conference in California this weekend, and all the real estate people that I was with meet another real estate person, and this person's like, I have 2,000 doors, and another guy has 2 doors, and the guy that is 2,000 doors or whatever goes to the 2-door guy and goes, dude, that's awesome, way to go, I'm really proud of you. Okay, and in my business, in the financial services business, somebody says something and we just all say, God, those people just suck. So it's amazing in real estate how encouraging everybody is to each other. Maybe you guys see a different part, but every real estate person just barreled up to the bar and we're just talking about the things they were doing. It was just hilarious. I'm like, do you guys not compete? They're like, no, not really. But what's interesting with the stock market, this is something that's not emotional, but right now, if you look at the markets in general, this is the average PE on the market, 30-year average is in the middle at a 16.8 times earnings. Right now, we're trading at about 22 times earnings, thanks a lot to the Magnificent Seven. Our philosophy is when we see ourselves one standard deviation above the average, we tend to lighten the load a tad, right? Which is the opposite of what everybody's doing. Everybody's like, glory, oh my goodness. My Democrats are like, Trump got elected. I hate him. I hate everything about him. Can we buy some NVIDIA? And I'm like, oh man. But if you look at the markets in general, when we're one standard deviation below, which is a 13.5%, 13.5 times earnings PE ratio, that's when you back up the truck a little more. But there's a lot of fear in that, and you feel sick. And so that's just an interesting chart to see where we're at. And I don't think real estate is in that. Real estate, there's certain things that have done really well, but real estate as an asset class in general has been a little bit tougher in the last few years. And I think it really stems from the fact that interest rates have gone up. And, in 2008, we had a massive, a lot of the people on this call, I'm guessing, weren't in the real estate business before that, or when they were, they just didn't have as much money as they do now. We all printed money, not the Federal Reserve, but we made money from 2008 and 2009 to now. And what I've noticed is that you gotta have some breaks, you gotta have some slowdowns. We still don't have enough housing due to way back then when everything like stalled forever. And so we're going to have a little bit of a slowdown, and it's really a little bit of a function of rate. So where the market's trading at a pretty high multiple, when I look at the real estate things that are out there, if you look at an existing apartment complex, what I've noticed is that the cap ratio, what people are paying, is definitely a seller's market. Right, it is a seller, so it's a seller's market out there. But where are you? There's some diamonds in the rough. What are you going to do? There's still not enough of it. Maybe what you do is you build something. I don't know, but I think there needs to be more of all of it, especially in certain areas. So if I look at our allocations, I'm an asset allocator, so you get rich by diversification. And so what I do to help myself, especially in my real estate portfolio, is to make sure that I've got it where I want to have it from a big picture perspective. So scroll down to the next slide. Here's another thing on the markets. People are buying this.
Jonathan, to your point on just being undersupplied in the US, some of the data that we've seen would indicate that in the last couple of years, most of the absorption of supply has been because of immigration. And I'm curious what you think about all the rhetoric around certainly slowing immigration, which has already happened this year, but potentially, mass deportation, and what's the impact on our economy if we deport 5 or 10 million people?
Yeah, first off, I would say that I think the deportation is a fear that people have. If I had to bet on it, I don't think that's going to happen. I think that that's what you say to people that are really worried about the border, right?
Yeah.
So will the mass happen? I just think it's probably too expensive. And I think that maybe what happens is you get rid of the people that probably need to be out that everybody would agree on. So I would probably argue that I think that that's campaign rhetoric. And, just know I'm a conservative. So it's kind of like Kamala Harris saying, I'm a centrist. Right. So think of it in the same vein. But I would argue that it depends on your market more than anything, as I'm looking at it. Affordable housing in all these places with young people, I think, is extremely important. And I think the tougher the economy gets, because one thing that was in this election that was ran on was how bad the economy is. I think we all want things better for us, but that was a miss, right? Like, yes, we've had massive inflation. Now let's separate the inflation with the fact that the economy is pretty good. I think that if you're renting things, I think that you're going to see, with a weaker economy, that I think we're going to have to hit a recession at one point here. You're going to be in a stronger position because less people will be able to buy it. I think that with rates being higher, I think that things for renters are looking good. It's just, what can you buy things for? But I think the immigration issue is a little bit overblown. I think it still comes back to normal supply and demand. And I think there's places like in the Northeast that people are moving out of. I mean, whether they admit it or not, we have a place, in Longboat Key, Florida, and all my neighbors are from Connecticut. Right. And so, but I don't see that I think it's an interest rate function, like with the weakness of, people say, oh, in Denver, the housing market's weak now. Yeah, comparatively it is, but rates are still high. Let's just get stuff to be moving, but I don't really worry about that too much. I think this affordable housing idea is key. And so, like in our family, and Tony knows this, we did in the middle of nowhere, Indiana. We did 38 units with Tony's encouragement on helping us think through that process. And, for us, it was more a matter of, I think the absorption rate there is really good and nothing's been built there for a while. And so I like the idea of thinking about real estate, not holistically, but thinking about it in your market and what's super attractive. What I worry a little bit about with real estate is, like St. Paul, Minnesota said, we're only going to allow people to real estate developers to increase rents by 3%.
Mhm.
Right? Well, that's a great idea. The problem is all those developers went over to Minneapolis and
Yeah.
did it. And now there's no development in St. Paul. And so I think that's really good news to get out locally in everybody's markets, because what seems like a really good idea to help people really makes it be a problem long term. So I think there's some things that just don't work in my opinion, right?
Right.
Like, people might say, Jonathan, you're totally wrong. I love a 3% cap. You do, but people that are in the development world aren't going to play that game, right? They've spoken loudly, and I think people are taking that in and listening and learning.
Yeah.
I guess my takeaway is my favorite places are, I think housing's still attractive. I think that if tariffs happen, I think small to mid-sized companies, either private companies or public companies that just do business in the United States, they will win if there's a major tariff situation. So I look at, if the market's trading at 22 times earnings and you can buy a company at 10 times earnings or 8 times earnings on the private side, that is in manufacturing or whatever else that's going to get a benefit boost. I think that's pretty important. So I look at those two areas as attractive. And then, is the interest rates really going to crash? No, I don't think they're going to crash, but I think that you're going to see the Fed actually drop rates. I think it's going to happen 4 times.
Mhm.
But if you listen to the news, it's not going to happen ever again. Right? So that is my whole business. I've done this for 24 years. And when I see everybody going in the same direction, and the direction is all around like bullish, things are good, 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 and it's going to stay good. I think we're going to see things chill out a little bit. I think rates are going to come down. And yeah, let's say that the 10-year stays at 4.3, 4.4%. Well, most of you guys, I mean, I don't know real estate that well, but most of you guys are dealing in the 5-year loan world. The 10-year loan world is great. But a yield curve that stops inverting is a good thing. So
Yeah.
if we get a lower rate on the short end and a higher rate on the long end, I think that's good for all other asset classes.
Back to normal fundamentals, right? I want to pause for just a second and say we've got about 5 or 6 minutes left. If anybody has a question, there's a Q&A button where you can type in a question, and we'll try to get to a few of them as we round this out. Yeah, I think you're right, Jonathan. Getting back to, how long? I think the yield curve's been inverted for 2 years or something like that, which is just a weird place to live.
Without a recession.
Without a recession, exactly. Crazy.
Yeah.
I guess too, John, you hit on this real fast, but this whole Doge move, right? We're going to have the Department of Government Efficiency, and Vivek and Elon are going to save the day. Talk a little bit more about that. And I think your first comment was, what are they really going to be able to change? Is there some hope that maybe there's a kind of like a bubble effect where just believing that that's going to happen is going to drive more investment activity and more, push toward efficiency? Do you see that happening?
Again, I think the outcomes are wide, right? So let's say we cut 2 trillion out of the budget, right? I think there's some ramifications that take place if you do things like that are probably not great, unless you cut like the entire public school funding system, or it'd be nice to have that at some level to try to lower it and to get some rules in effect, right? So yeah, I believe that we're going to see a lot of nothing on that. That's what I think. I think that it's going to be, I think Elon Musk and Donald Trump won't even be talking in between 3 and 6 months from now. Like they can't be friends. I don't see that happening. myself. But I think that there are some other things though that will be interesting. So like, I don't know if you saw the ExxonMobil CEO come out and say, "Hey, everybody, this is great with this drill baby drill idea." But the problem I have is that I make decisions for 100 years. And so can we get some policy? And so if you look at my clients that are conservative and that are left leaning, what I notice with all of them is they all think that fossil fuels needs to go way down and go away over time, which I think is fascinating. So as I look at things like deregulation and all that, I think that deregulation is a good thing. For the most part, it can be bad, right? But like in my industry, in order to get on this Zoom call in my industry, I had to get like 19 approvals.
Yeah.
And that's not my firm, that's like the SEC,
Yeah.
right? So there's a lot of things like that. But I also look at like energy and all that. I look at it and I say, hey, these guys, these poor guys that are running these companies, what are they supposed to do? Like they're making decisions for 50, 100 years. It's hard for them to make that decision. Let's all be on the same page that we're trying to make fossil fuels help us in the short term, because we know China and all them aren't going to follow any type of Paris Accord. And how do we get clean energy over the long haul? How do we do that? And I think these CEOs are calling out for that. So I think there's some things, if we don't go to extremes, that could be really good here. But as far as the spending less money and all that, I don't know if that's in Trump's DNA. That's not how he grows things.
Yeah.
We are going to cut taxes and we're going to deregulate, and we're going to pay for it by tariffs. That ain't going to work, I don't think.
Right.
So we have to grow fast.
Right.
And I'm not, and that makes me very nervous, because that's almost like, that's like, that's like hitting the bullseye perfectly. So I think that we could be in a little bit tougher economy than what we all think it will be. I don't think it's going to be Trump's last 4 years on the economy. I think that he's taking over in a really pretty good time. Inflation has just come way down, and GDP growth is off the charts. And if you look at companies on general, if you look at the Sherman-Williams paints, you look at all this stuff, you look at real estate, yeah, things are expensive and a little bit unaffordable, um, but things are good, right?
Yeah.
They're not that bad. It's not that bad out there.
And really for prices to come down, right? We're talking about inflation coming down. We're not talking about prices coming down. Like prices coming down equals deflation. And I think that's a common, maybe misconception. I was with some family over the weekend and it was like, okay, this is great. All of the prices are going to go down. And Jonathan, is that true? Are prices going down? Like, is milk going to get a lot cheaper? And, gas maybe gets a little cheaper in a moment here and goes back up. Like what?
Yeah, that's the
That's
problem with inflation. Is inflation, when you get smoked like we did over the last few years at 7% a year or whatever, that doesn't ever go away,
right.
right? It just means that we're stopping that. So like, what does it cost to, what does it cost to build something? So if I look at my building I'm sitting in and I look at what it would sell for, the rents suck probably, right? It's probably half full. But to build this thing, that's a lot of money. There's some equilibrium that has to take place.
Yeah.
Is the housing market going to correct? I'd be shocked. I'd be shocked. Is it going to not rally like it did over COVID? Probably.
Yeah.
But it's going to be more real. And we're not going to have the glory we had since 2009. We just have to make really wise decisions and work really hard to get rents, get people in place. That's what I love about real estate. But people always say, I have always lost money in the market. And I'm like, that's because you probably panicked.
Right.
Right. But real estate, the beauty of it is you buy a piece of real estate and you didn't buy it perfect. What I love about real estate is that you just have to wait a little longer. Right.
Yeah.
You just pay it down. You're just paying it down. You got your people living in whatever. You got people, renters paying. Everybody tries to be so perfect in how they buy everything, which I think is great, and go for it. But like I mean, this is crazy, but I have meetings with my kids, which is they're college kids. But I'm like, you can only give your kids what you have. And I can talk about this, but I can't like fix anything. And I don't really know how to do anything. I'm very not diverse in my knowledge. But I'm like, hey guys, just so you know, like the job is getting in the game and buying it as good as you can. But then after the fact, you might have learned that you didn't do it perfectly. And that's the beauty of appreciating assets rather than depreciating assets. And so big picture, I think people need to get in the game earlier. And then once they're in the game and they realize they didn't make a big mistake, stick that in your brain and use that as knowledge for the future and keep going and rent the crap out of it, right? So it's a matter of how hard you work, and then what do you own for the long haul. So I'm also not a big trader, so I'm a believer that you buy assets and you kind of hold good assets, which is very odd in the world of Robinhood or the world of, hey, let's buy a piece of property, let's get it rezoned, let's get it rented out, and then we're going to sell it. I think that's awesome, and people can do it. They're just more talented than me. I'm not that talented, so I want to get it rezoned, I want to get it rented, and then I want to like reap that reward over time, right? So, yeah.
We did get one question. We're over our time, and when I invited Jonathan on, we should have extended the length of the webinar, so that's my bad. But because there's just so much wisdom to share, right? So one of the one question though, Jonathan, that popped up is, suggesting that health in the economy rests on real incomes continuing to improve. Where do you see income going? Obviously, income growth has outpaced inflation recently. Is it likely that incomes continue to rise?
I would say that it's going to be more volatile going forward. If you look at our workforce situation, what I've noticed is that a lot of employers have to be in a situation where they want people to retire to get somebody in that gets paid less. Okay. So what I would argue is that I think incomes go up because if somebody is 65 and they retire and they're making 200 grand and you replace them with somebody at 100 grand, that person's going to work their way up as well. So I do think that there's growth, but not like we've seen it. I mean, we've seen like hourly workers' wages go crazy, which in turn makes livable wages good, but it also makes McDonald's more expensive.
Right.
So let's take that out of the equation, right? And then let's take the normal employee. I think those wages go up, but I don't think that those employees will be able to say, hey, by the way, I only want to work from home and I'm not going to take this job unless I can work from home. I think that there's going to be a little bit more of a give and a take between so the employers have ruled the world. And then since COVID, the employees have ruled the world. And I think that we're going to see a more moderate version, but I can tell you that like my staff that is 30, 20 is not so much, but 30 to 50 are going to be making more income. And that's really the group that needs it. I think we're in this world we live in. I think there's a middle class conundrum where you might want to send your kids to college and you literally can get nothing.
Mm-hmm. Mm-hmm.
Right? Yeah. But you're like, hold on, but this college is this much money and I don't make that kind of money. I think that you're going to see those middle class incomes continue to rise. But I think that you're going to see people not be able to control their work environment the way that they have and change jobs. The big thing is I get applications for people all the time and they have a new job every 2 years. I don't care how good they were. I just throw it out because I just know that what they're doing is jumping jobs, but they're making more money. I don't blame them at all. I just don't know if that's a fit for me. And I have to convince the people that come to work for me that, hey, over time, we're going to build an environment here that really works for you.
Yeah.
And I think the 2-year job jump thing is probably coming to an end. And if I'm throwing out those resumes, unless you have a really good skill, you're not gonna be able to do that. And like in my industry, all my big math quant dudes, I don't need them anymore. I got that on my phone.
Right.
So it's how do you take what you can get off your phone and bring it to the next gen? These young people in our world need to be able to talk, right? So like the whole idea of being really smart about YouTube in it is awesome. The problem is that those people that I've hired that I needed to do technical things now have to take the technical things and take them to the real world. And so this idea around like I'm literally got people in Toastmasters right now, which is like 1975, but they're having fun with it. They love it. And I'm like, do Toastmasters. I think I need you to be able to communicate what you're doing. And let me tell you where we're going with your job, that your job is, yes, still in this space, but we don't need you to run those numbers anymore. And they're like, oh no, I am screwed. I'm like, no, you're not. I just need you to have a little different skill set. So the idea of adaptability within your job, if people can adapt in their job, the job wages will keep going up. And if they can't adapt, I think that those jobs, people always say it's going to go away. It's not going to go away. It just is going to be not as good for you. I think that adaptability. And if you say you're a salesperson, you better be able to sell something. Right. So right now the salespeople sit there and they're like, I worked 8 hours a day and I did these 5 things and I sold nothing. And in today's world, that's okay. But in the real world, if you're in sales, you actually have to move whatever you're moving. And those days are over too. So doing what you say you can do has to happen now. But I think wages are going to go up with that. And the talented people will get paid because the people like me aren't getting any younger. And I need more and more. I look at my clients who are in their 50s, they're done. They're bringing everybody along.
Yeah. That's really good.
Going way too long now.
Well, this is great. And so I'll wrap us up. Thank you so much, Jonathan. You're our first esteemed guest on an investor webinar at Atlas, and really, really appreciative that you took time out of your day to share wisdom with us and insights on the market. Thanks everybody for attending. We are going to shoot out a survey after this, I believe, to get your feedback and what you'd like to hear from us in this context going forward. We want to continue to add as much value as we can. And as we always say, thank you so much for entrusting us with your assets. We take that stewardship incredibly seriously and look forward to continuing to work together for years to come. So thanks, Jonathan. Thanks everybody else.
Thanks for having me.